Hello, everybody, and thank you for joining this week's 5-Minute Brainstorm, our weekly Wednesday webinar. I'm Chris Orestes, and it's a pleasure to be able to talk to you all today about 5 wealth transfer strategies, things to think about when it comes to transfer of wealth. You know, people work a lifetime creating wealth through income, savings, investments, building up businesses, acquiring valuable assets. It's a lifetime effort. It's in some ways a way that people are keeping score in life. But what not enough people think about is how to set things up correctly to transfer that wealth to the next generation. It's always very surprising to me when I talk to people who don't have wills in place, have not considered really how to make sure they're maximizing the eventual transfer of wealth, whether it's pretty well expected at some point in the future, or could happen in an unexpected way. Not being prepared can be a real disaster, and really take a huge toll on a lifetime of work. Mistakes too often are being made. People are lacking documentation, having it well put together. Wills and trusts are not in place or outdated. Pension, retirement accounts are not positioned correctly for transfer at a future date to another generation. People miss out on the opportunities when it comes to gifting, and how that relates to overall estate taxes and their estate tax thresholds. And for so many people, the use of insurance is misunderstood. So let's go through some wealth transfer strategies to bear in mind as you're working with your clients and looking at your own position today in life. Start with wills and trusts. Having an up-to-date will in place, and then the correct trust mechanisms to handle assets, protect those assets if they transfer to the next generation. Very much particularly in the case of people being too young to receive those assets, or maybe just not capable of managing them correctly. Wills and trusts will help to put in place the guardrails, the safety measures, and make sure that things transfer in the way that you wish. Also, above all else, you've got to avoid passing away without a will and then throwing your family into probate court intestate, trying to work through a situation where wills and trusts were not put in place. And now it's in the hands of the state and a probate court to navigate and negotiate how that's going to end up being divided up in the end. Also, inherited IRAs. It's an interesting situation. IRAs can be set up inside the investment management group, actually, to maximize their ability to continue growing with tax-deferred buildup for at least a 10-year period. And then as the money is distributed, done in a way to minimize the tax impact. You can also set up trusts, IRA trusts, with the investment managers to make sure that the IRAs are managed and protected correctly for the beneficiaries. So I strongly recommend, if you have IRAs, 401k rollovers, that you would talk to the investment managers about making sure that the beneficiary status and the potential of them rolling over into an IRA trust is examined. Next, taking advantage of gifting. On an annual basis, you can gift any one person as an individual $15,000 a year, or as a couple $30,000 a year to any one individual on an annual basis without incurring any tax consequences. This then is measured against the lifetime gifting cap, which is the equivalent of the estate tax threshold today, which that number is $11.5 million for an individual and twice that for a couple. In 2026, that number is going to adjust downward, but as of now, you have one of the highest estate tax thresholds ever, and your gifting capability on an annual and lifetime basis is up to that estate tax number um, in a person's lifetime, avoiding estate taxes. Family limited partnerships. Here's an interesting mechanism to pass on business interests or assets where a family limited partnership is established with the owner of the interest, the assets or business as the managing director of the family partnership. And then over the course of years, on an annual basis, starting to divest and pass off shares of interests in the assets or the business, and staying within the gifting limits and estate tax threshold, you can pass along a significant value in assets and business interests, avoiding estate taxes. GRATs and intrafamily loans. A GRAT is an annuity trust that will generate a annual income to the grantor of the annuity with a minimum level of interest, which qualifies it to then be within the gifting limits, and can transfer any remainder in the annuity to the beneficiaries tax-free, as long as the it's an actuarial set time frame with a federal level of interest associated with the amount of money that would get paid to the grantor of the annuity, which is sub 1% as an interest rate, with then the remainder transferring to the beneficiaries of that annuity tax-free. Now, intrafamily loans are set with a minimum federal interest rate known as the AFR, which then would be considered a gift if the loan is forgiven and avoid taxes, because again, you're inside the gifting and estate tax threshold levels. Then proper use of insurance. Listen, life insurance is another way to build up some significant value and wealth for the transfer of wealth, but also to protect value and wealth while someone's alive. Because when you have, depending on the type of insurance product that you're going to use, you can build up cash surrender value. You're building up tax-free value in a policy, increasing potentially its worth, which ultimately will pay out a death benefit to the beneficiaries tax-free. So the proper use of insurance vehicles as life insurance, or potentially those that could be converted to cover long-term care costs, avoiding the need to then raid other assets, income, savings, and investments to cover the cost of long-term care, is another way that insurance can be used to help ensure wealth transfer. Then for a policy owner that decides maybe they've no longer in need of a specific life insurance policy, they could obviously look to settle it in the secondary market through a life settlement, and get a significant payout while they're alive, which they could use to cover expenses or add to their current wealth accumulation. So at the end of the day, and I always say this to people, as an American, it is our responsibility to build up as much wealth as we can and then pass it along as much as possible to other generations, minimizing what we're paying out in taxes by using every possible vehicle and mean that is legally available to us. And there are certainly a number of vehicles available to minimize the impact of taxes and maximize the ability to grow wealth in tax deferred or pre-tax vehicles, to then be able to well-constructed pass on to other generations. So minimizing taxes while you're accumulating wealth, minimizing taxes when you pass along that wealth. At the end of the day, there's nothing more American than that. It sits right, in my opinion, next to baseball and apple pie. So I want to thank everybody for joining today's session, and encourage you, as always, to join us again for our weekly Wednesday webinars. And let's take a look. Next week's schedule, as always, will be something interesting, timely, and we look forward to seeing you again on next week's Wednesday webinar, a 5-minute brainstorm.